Hey everyone, welcome back to Corporate Decoder. Ever wondered what's hiding in those super long, boring documents that companies file? Well, let's just say sometimes it's juicier than a reality TV show, maybe with less drama and more numbers. In this video, we're cracking open the latest SEC filing of Emmis Accession Corp to see what's what. It's like being a detective, but with financial statements. So, Emmis Acquisition is trying to raise $100 million through an initial public offering, but what does that really mean? And what are the risks? What interesting details can we find? If you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below. Feel free to ask questions or find new insights. Alright, let's get into it. This document was filed with the SEC in July of 2025. The company we are analysing is Emmis Accession Corp. It is a blank check company, or what people also refer to as a SPAC. Basically, it's a company with no real business. Its only purpose is to find another, hopefully real company to buy or merge with and then take public. Think of it as a treasure hunter that is hunting for a company. Their goal is to find a business to merge with, meaning they want to take another company and bring it into the stock market. They have 18 months to do it. They can do it in many ways. A merger where two companies become one, a share exchange where they swap stock, an asset acquisition where they buy stuff. Emmis is like a general contractor without a building plan or construction site yet. They have no idea what company they're going to take public, though they can chase any industry. They are leaning towards service, manufacturing, or distribution companies. They are hoping their team has great financial, acquisitions, capital market, and people skills to get this blank check business up and running with the right target. Their chairman and CEO is Peter Goldstein, who has a background in capital markets and M&A. David Lowenstein will be the CFO and director who has experience in scaling businesses and M&A. They want a company with growth already, profits and good growth chances, a business that stands ahead of the competition and can be improved. Now, there are some rules. Basically, the merge target needs to worth at least 80% of the money they have in the bank to make sure they don't acquire tiny little business with big number claims. Where will the money come from? From this offering plus a private placement, where basically a few investors buy up the company even before it goes on the market to regular people. Alright, who owns this thing? Their team has founder shares, so their interests and yours might not be in sync. Plus the pressure. The team risks losing basically all the shares if they don't find a merge target. It kind of makes you want to accept any offer you can get. Also, there's conflict as the officers may have an interest to other entities, so maybe, just maybe, they won't show you all the options. If Emmis doesn't complete the IPO in 18 months, maybe extending to 36, the sponsor will not get a return on its investment. If the IPO fails, the sponsor's stock will likely prove worthless. The sponsor won't be left totally empty-handed. Here are some payments that the sponsor and management team will receive. They can get $10,000 a month for utilities until a deal is made, but the amount is capped at $300,000. They may get finders or consulting fees and reimbursements for any out-of-pocket expenses incurred while identifying and completing the business combination. They did put $25,000 to purchase the founder shares, and in the event the IPO fails, there will be a substantial dilution to the investors in this offering. Okay, let's talk numbers. Their financial data isn't too exciting because they're, well, a blank slate, but here are some key items from the book's working capital deficiency. This is a negative number of around $60,420,000. Total assets are just $50,000 and the shareholder deficit is about $16,450,000, which shows how the IPO will impact the company. Here's how your investment could get diluted and not be as good as you hoped. Even in their best scenario, the net tangible book value is going to be $7.37 for price offering of $10. If everyone redeems because you don't like that target company, you get back just over $1 at 1.08 everyone redeems because you don't like that target company. You get back just over $1 at 1.8 cents per share. Remember, these numbers do not take into account other market factors from their initial business combination. It is worth mentioning what some of the main risks are with this company based on the prospectus. As the issuer, they may not have the skills to successfully find a merger, even if they find the target. If their shareholders do not vote with them and redeem those shares or elect to move on to another offer, the deal could be off guard, and last, the small price sponsor paid can lead to significant dilution for you, the everyday public investor, even if the company does well. Now, looking at these results more broadly, Emmis Acquisition Corp is really betting big on its management team to make them money down the line. It does have multiple high risks. So what are they saying with this blank check? If you have high risk tolerance, this might be for you. Alright, that exap's our breakdown of Emmis Acquisition Corp's latest filing. What observes your take on these numbers and what they signal for the company Accession future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.